Between September 28th and September 30th, RBI's Monetary Policy Committee will get together and deliberate India's monetary policy stance. This happens once every 2 months. The Monetary Policy Committee, which has members nominated by the government and the RBI, comes together and discusses what needs to be done in terms of controlling inflation and boosting India's economic growth. For a while now, inflation has been a massive concern because since January this year, India's inflation has been outside RBI's comfort zone. As you might know, RBI is legally required to target a 4% inflation rate. It has been given by law a leeway of 2 percentage points on either side. So the comfort zone for RBI is between 2% and 6%. But it needs to target 4%. What has been happening since the start of this year, to 2022, is that retail inflation has been above 6%. In April, it reached 7.8%, which was the highest retail inflation since the new government under Prime Minister Narendra Modi took office in 2014. Now, there are a few things that you should expect when the RBI meets later this week. One is that RBI is expected to raise interest rates further. Now, some of you might know that in May, RBI did an emergency meeting and started raising interest rates because it realized that inflation is going out of control. And there were massive pressures through the Ukraine war and the commodity prices increase. That meant that there was no way RBI could ignore the inflationary surge anymore. Since May, RBI has already increased interest rates by 140 basis points, which is 1.4 percentage points. And it is expected that now, in the coming meeting, RBI is likely to increase it by another 50 basis points. But there's more information on this, because one of the reasons why RBI is raising interest rates is not just about controlling inflation at home, it's also about protecting the rupee. The US Federal Reserve, the central bank in US, and many other central banks have been raising interest rates quite aggressively, US in particular. And that has basically meant that the differential of interest rate between India and an economy like US has reduced, and there'll be pressure on rupee. So for both reasons of inflation and for control of rupee's value, RBI might be forced to raise interest rates further beyond the 50 basis points that it might do this week, because the US Fed is determined to continue raising rates by another 100 basis points, perhaps in the near future. So that is the first thing that might happen, that interest rates for all of us might go up later this week. That basically means all our EMIs for home loans, car loans will all get costlier. The other thing that might happen is that RBI might decide to cut India's GDP growth forecast. Now, in April this year, RBI said that India will grow at 7.2% in this current financial year, which runs between April and March next year. However, since April to now, RBI's inflation forecast has changed quite dramatically. In April, it thought that inflation would be 4.5% in India in this current financial year, but now it turns out that inflation, even by RBI's estimate, will be 6.7%, well above RBI's comfort zone. And as a result of that, RBI has been raising interest rates. As I mentioned, it has already raised it by 140 basis points. Another 50 basis points hike might be in the offing this week, and there might be another 50 basis points in the coming months. So as a result of all these increases in interest rates, it will drag down India's economic activity. So from April's assessment of 7.2, it is possible that RBI might have to tweak it and dial down India's GDP growth estimate for the current financial year to something like 7 or maybe a tad below 7. But that's broadly the two big likely takeaways from the forthcoming RBI monetary policy. Thank you.